Good afternoon and welcome back to the latest edition of the InvestTalk market analysis for the week ending May 24th, 2024. Appreciate you all tuning in, liking, and subscribing to this channel and our podcast, InvestTalk. I am host Justin Klein, and today I'm going to title the video, Housing Data Disappoints, but is that signaling a crash? Now, in the YouTube world, and just the media world in general, there are a lot of doomerism. There's a lot of doomerism surrounding housing. And all this is driven by PTSD from '08, and everybody's worried about the next housing crash and everything. And so it's all looking at the data and trying to cherry pick particular data points that sound scary, that tells you, oh, everything's going to hell in a handbasket. But and everyone points to affordability, they point to mortgage rates, and while that is important, and not saying that isn't a factor, it is only one piece of data. So I have a list of charts here I'll show you in a second that breaks this down and helps you understand where are we really. Okay, now the data this week, new home sales for month April, that came in down 1.9% month over month. So overall, it was a disappointing report. You can see, this data, this is existing home sales, and you can see that ticked down recently. Let me zoom into year to date. There we go. And you saw that tick down 2 consecutive months here. And yes, it's at very, very low levels, but does that tell you the market's going to crash? Let's dig into that in a little bit. Now, this is a new single-family home sold that also came out disappointed, down 4.6%. Okay, and what you can see is this is at pretty low levels and headed downward. Okay, so everyone's going to say, look at home sales, they're struggling, and that means housing prices are going to crash. First thing you have to understand about housing prices is that nobody's forced to make a buy or a sell until they do, right? Meaning in '08, '09, there were a lot of forced sellers. People couldn't afford their homes, they were underwater, banks were repossessing them, and banks don't want to own the homes, and they were forced selling them. That's what pushed inventory up dramatically. In a normal environment, there's not a lot of forced sellers. And until there are forced sellers, that's housing prices are going to stay relatively elevated because those sellers just keep them on market a little longer when they're not forced to sell them, right? You have an idea of what you want to get, and usually most sellers, they kind of keep the house on the market until they get a price that they're willing to accept. That's reasonable to them, and usually it's above what they paid for it. Okay. Now, this is a very good chart deck here from Apollo that looks at the current housing market. So let's go through this. Okay. And they talk about low supply, pent-up demand, job growth, wage growth, etc. Okay. So this is the housing deficit. Okay. And they look at the trend, the blue line, and then household formation. And it's saying basically since the pandemic, household formation has been well below trend. And they're saying that's mainly because there haven't been enough homes built. Okay. So household formation versus trend. That means they're undersupplied. We're undersupplied by about 2.3 million homes in this country. And that's just getting back to baseline. You have to get above this trend for things to get pretty ugly. And you can see back here in '05, '06, we were building way more than the trend. Or sorry, that was formation was higher because it was easy to get into homes. Okay, now it's not as easy because of prices, etc. And that just means that there aren't a lot of homes being built. Okay, now the second slide here is also extremely important because it looks at the number of homes without a mortgage. We have a lot of boomers retiring, and we always tell our clients that, you probably want to pay off your mortgage by the time you retire. And there's a huge cohort of Americans in the boomer generation that have done just that. They were able to get very low mortgage rates, and their Stock prices went up, bond prices went up. A lot of them sold assets to pay off mortgages, and they tend to be fairly conservative, especially after '08. Remember PTSD, okay? And so when you have 40% of people, or 40% of homes not having a mortgage, that means those owners aren't really in a hurry to sell, right? Unless they need that money. They're not going to, the bank's not going to foreclose on them because the loan is paid off. So you don't have 40% of the homes are taken off of the potentiality of a forced sale, okay? Which is way higher. You can see back in 2010, it was only 33%. And this continues to rise, okay? And will likely continue to rise as, boomers get older and older and more of them retire. Then you have 30% of homes still selling above their list price. You can see back in 2012, when that market wasn't that great, it was kind of a more balanced market. You had somewhere in the mid-teens, and that's where it averaged between kind of mid-teens and 25%. And we're up until the pandemic, pre-pandemic, we were at about 20, low 20s. Now we're at 30. So you can see that even though this has come down from the 50+% in early 2022, it's still elevated, okay? Which means that there's still low inventory. And what you can see here is this is the red line, the current inventory for the year, and it does typically go higher through the summer and then trail off as you close the year. And what it's showing you is that look at 2018. That's the green line. 2019 is the dark blue line here. And 2020 was the pandemic year. And we're still well below those years. So we still have a while before we get up to the number of active listings, okay, that we saw pre-pandemic, which nobody said the housing market was crashing in 2019. It was a fairly balanced market, okay? Then you have housing inventory per person, still very, very low. Pre-pandemic, it was about 1.15, 1.14. Now we're at 1.12, right? It's ticking up, yes. And that's what people post will look at. You'll see these doomerism posts about how, oh, inventory is up 32% year over year from, in this market and nationwide, et cetera, and using these big numbers and making it sound bad. But what they're not showing you is that it's from very, very low levels. So when you have a low base, it's easy to show big rate of change numbers, okay? And then you have existing housing inventory and months supply versus total home for sale. You still only have about 1.2, 1.3 million homes for sale. Look back during the housing crash. We were at nearly 4 million homes for sale, about triple the amount of inventory that we have now on the market. And then month supply, which is always an important number, we always say between about 4 and 8 is fairly healthy. Okay, somewhere in that range. We're still over here. We're just approaching 4. Okay. When you get above 8, that's where things go awry. So you need inventory to come up dramatically for prices to go lower. And then you are seeing people planning to move. That obviously is future demand for housing. Okay. Say if you live with a roommate, say you live with parents, you're planning to change your primary residence, a lot of these people are going to be looking for homes. So, an uptick in the demand, right? Then inventory, the investor share of purchasing homes is rising. This is what kind of surprises me, especially with the yields that you can get in corporate bonds and treasuries and elsewhere. The cap rates across the country are still relatively low. Now, what I think the driver of this is more that permanent capital, money going into those private REITs, going into, you have your private equity firms from BlackRock, et cetera, that are buying up homes. But I think that is likely to ebb over time. So this is something I do think will come down. But currently, investors' share of the housing market is still pretty high. Okay, so they're not backing off yet. And they're also partnering with a lot of these home builders and saying, okay, I'll buy a big chunk of these homes just to rent them out. Okay, so those are homes that are immediately coming off market. They're being built. That's resources, workers, capital that is being used to build homes for rent, as opposed to homes for other people to buy, individuals to buy. Okay, and you can see employment construction, while it was dipping lower in the last summer, now it's increasing. So the home builders are not backing up. They're not stopping because of what I showed before was the housing deficit. They see that. Okay. And this is that rate lock number of homes with mortgages below 4%. We know that's very, very high. Let's see, demand application, that does remain relatively low. Home buying plans does remain relatively low. So that's what people will point to. But this needs to drive inventory higher for prices to fall, to have people that have a home that's on market, and then for it to sit for a long enough time for it to really cause a problem. Meaning, I'm going to lower my price in order to get it sold. Okay. So once again, the inventory has to go higher. Now, mortgage credit availability index, this remains still very low, which means it's easy to get a mortgage, as long as you qualify. Mortgage origination is still very, very low, though, because of that low demand. And yeah, this is just, I don't want to go too far into this, but yeah, this is population by age. So this is, yeah, a lot of first-time home buyers are 31, okay? And this is where a lot of the population is, right? So these are the boomers. The older boomers are dying off. You see that here. But this is the prime buying age. And so, even if prices dip, generally you're going to see demand for housing go up. Here's household formation year over year, right? That's been increasing since the pandemic, and it's relatively high compared to where we were kind of mid 2000s or mid 2010s. Um, Yeah, so I mean, I can go deeper into this. Obviously, it's a very, very long slideshow, but it's definitely a housing market that is just getting in more balance. It's not falling off a cliff or anything like that. Don't listen to the doomers on YouTube, on social media. The data does not back that up, that housing prices are going to crash anytime in the short to medium term. Could dynamics change in 2 to 4 years? Sure, but housing market's slow to move. Right? We peaked in '05 in housing prices, and you didn't really get a crash until '07, '08. Okay, it took 2, 3 years for that overbuilding and lack of affordability to really bite. And you're like, that's likely the same thing going forward. Now let's go dig into the other economic data. Continuing claims for unemployment insurance, that did tick up, but obviously kind of in this range we've been in. So not breaking out and showing, that the jobs market is falling off a cliff, because it's not. It's weakening minorly, but it's still relatively robust. Kansas City manufacturing production, that's still negative territory, but ticked up a little bit. Durable goods orders ex defense, that does remain in a downtrend, but it's just getting back to more normal levels. So I wouldn't be too worried about that. You're still getting pretty robust demand for durable goods. FINRA margin debt, this is something I will continue to watch to see if you get a reversal. And this is basically talking about forced selling, is when there's too much margin debt, and those that are in margin, they cover, and they have to force sell their stocks. That doesn't look like it's happening. You do get a dip down in the month of April, but nothing really to worry about. Now, all this being said, what's interesting about this week is the Fed got a bit more, at least the pricing around the Fed got a bit more hawkish. We know that QT is being wound down. The first tranche starts here June 1st, meaning they will lower their QT, their shrinkage of the balance sheet, from 60 billion a month to 25 billion a month. So that is dovish. That is effectively their first rate cut, or their first easing action. Everyone focuses on the rates, but it's other factors behind the scenes, like QT, like reverse repo, like the Treasury General Account, like issuance from the Treasury, whether it's bills or notes. All those things matter far more than rates. But let's talk about rates. And what's interesting here is there were a week ago you had odds of a cut, about 9% odds of a cut in June. It's coming up in just a couple weeks, right? June 12th. But now it's a slight chance there'll be a rate hike. Okay. July, you have only a 10% chance of a cut and about a 1% chance of a hike. September, you have about 50-50 between a cut and a hike. So what this is saying is economic data isn't going to support a cut over the next 2-3 months, but could going into the end of the summer. And then November, you have better than 50% chance of a one rate cut. And by December, which is what most people talk about, you're talking about base case one, maybe two cuts. So about 1.5 cuts really priced in. And that's a far cry from the 7-8 cuts that the market had priced in at the beginning of the year. I still think they cut rates at the end of the year. My base case is one cut in, in December. I think we're getting close to the election, especially when you start getting to September, right? That's the heart of election season. There'll be a lot of discussion around Trump or Biden, or maybe it's RFK. We will see. But I don't think that the Fed will want to try to influence or perceive that they're trying to influence the election in any way, shape, or form. So that's kind of where we're at on the economic front, but let's dig into the charts. I know you all love the charts. And I'll start off with the credit spreads, short-term junk, short-term treasuries, and that's fine, right? Yeah, nice little sell-off on Thursday, but rally back on Friday. So no real issue on that front. Let's look at the NASDAQ. We had NVIDIA earnings. Okay, let's see if I can pull up NVIDIA. I'm sure it's here. Here it is. So that had good earnings, and you did get follow through to the upside on Friday. So everyone was worried that that might take the market down. NVIDIA is obviously highly there's a lot of attention around the name, and a lot of retail investors getting into it. And will this continue to hold, or do you get a reversal? You got a reversal in things like SMCI. Didn't really get that. Didn't really take off after the NVIDIA report. Same with AMD, that kind of sold off. And just broadly, the SMH, it was up because it's NVIDIA's biggest holding, but it did kind of give a lot of that back on Thursday. It didn't close above that on Friday. So I'll be very interested to see what semis do as well as NVIDIA does next week. Let's take a look at growth of value. That did look like it's taking off. I will be very interested to see if this holds as well, something I will be watching. What else? Oh, the dollar. The dollar, I think, is getting ready for a rollover. You're seeing this MACD rollover here, and if you look at things like the yen, that is starting to show some divergence here as well, right? You had this is a fairly red line code, shall we call it, in Japan, it seems, where they wanted to strengthen the yen. I believe they did something, I forget what it was, to support the yen, but that's pretty much all been given back. But, do they step in again? Does that weaken the dollar? And what does that do for things like gold? Gold prices did pull back at the end of this week, but you're going through, I think, a consolidation period, at which may last another few weeks or couple of months. So I'll be on the lookout for that, but I will continue to buy the dip in that space. Let's look at commodities. Commodities did get a pullback just with gold, but once again, this is now in an uptrend. And if you look at things like base metals, look at that. There's DBB. That's the base metal ETF. You go DBA. This is agriculture. That also did have a pullback, but still remains in an uptrend as well. And if the dollar can get any traction to the downside, then I think those commodities take that another leg higher. The S&P did have that reversal on Thursday, but we did not get a follow through. Okay, let's zoom in here. And this is let's go to the SPY, because that's always interesting to see what the volume is on that. Yeah, not see that's the issue is there's not really a huge amount of volume that is being that was applied to that sell-off. So, how much credence can you give this when you just get a low volume sell-off? We got that here, okay? Same thing. Reversal, it looks very similar, right? You had the big reversal day, you had a rally, and do we get a failure next week like we did here, and you get another pullback, say, to the 100-day moving average? I think that's very possible. Okay, very, very possible in this market. We are heading into quarterly OPEX in the month of June, and that typically is a time for a bit more volatility. But nothing signaling that that won't be anything more than what this was, which was a minor pullback in equities. Could we get a lower low? I think that's what would be interesting. Do we get a higher low or do we get a lower low? I think we get a higher low and we head higher into the summer, but anything can happen. Let me move over to the move index. Move over to the move index. That does continue to be in a downtrend. Obviously, that's good for the treasury market. Let's look at URNM. Uranium did have a bit of a pullback, but that remains in an uptrend as well. What are the other? Just trying to see on my dashboard if there are any other major stocks that I wanted to cover, major industries. I think that's about it. We could look at the XLE. That has pulled back here, but once again remains in an uptrend and is hitting some support. Big, nice support would be down here on the XLE around 86. Also 89 would be good support around the 100-day moving average. That's probably where I would step in probably aggressively on energy because I do think energy does move higher into the back half of the year. The VIX, this is another indicator that, hey, everything is fine. You have a lower low now, and you could go through a period of where volatility stays sub 15. If you do, guess what? Equities are just going to float higher. So that's kind of where we're at. So near term, it was Thursday a signal that there's a pullback for June? Very possible. But nothing is signaling a major reversal in markets. So till then, you have to buy the dip because earnings are still remaining robust. And we know in an inflationary environment, what's one of the best hedges against inflation? It's equities. All right. I think that's about it. I appreciate you all tuning in and subscribing to this channel. And a reminder, the contents of this video are for educational purposes only. It should not be construed as a recommendation to buy or sell security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend.